Welcome to the deep dive. Today, we're looking at something pretty interesting, a real market paradox.
Yeah, what's that?
American Express. They just posted these stellar Q2 2025 earnings, right? Blew past what analysts expected.
Okay.
But, and here's the twist, their shares actually fell in pre-market trading.
Oh, right. I saw that. So strong numbers, weak reaction.
Exactly. So our mission today is to unpack that, what's really going on inside Amex. We'll dig into their earnings call, their presentation, and figure this out. Ready?
Let's do it. It really is a bit of a head scratcher on the surface.
Right. So lay out those headline numbers for us, the ones that beat expectations.
Okay, so first off, EPS, that's earnings per share, a key profit number, it came in at $4.08.
And the forecast was?
$3.87. So that's a pretty solid beat, like 5.43% surprise.
Nice. And revenue?
Revenue also beat. They hit $17.86 billion versus the $17.7 billion expected. Actually, their total quarterly revenue was $17.9 billion, record highs.
Record, wow.
Yeah, up 9% from last year. And even if you take out some one-off things, like they sold a unit called Excertify, their adjusted EPS was $4.80. That's up 17% year over year.
Okay, so the numbers look fantastic. No question there.
None at all.
But this is where the paradox kicks in, like you said.
Yep.
How does that strong performance lead to a stock dip? What's the market really thinking here?
That is the million-dollar question, isn't it? Despite those beats, yeah, the shares slid, down 3.17% in pre-market. And what we're hearing, the analysis suggests it's partly wider market jitters, but also specific worries about Amex's future growth. Can they keep it up?
Concerns about maintaining momentum.
Exactly. And their premium pricing power. So the stock went from around $315 down to $313, moving away from its recent high, which was near $329.
Okay. And the valuation metrics, like PE ratio?
Yeah, the price-to-earnings ratio is sitting around 21.98. It signals maybe a bit of caution. And analyst targets, they're all over the place.
How wide a range?
Lowest is $255, highest is $371. That spread tells you there's some real uncertainty baked in about what happens next.
So it's not just about last quarter's results, it's about the outlook. The story investors are telling themselves about the future.
Precisely. Forward-looking concerns.
Okay, let's dig beneath that surface then. How does the core business look operationally? Day-to-day health.
Operationally, things look, well, very solid. Total spending by card members, up 7%.
Okay, steady growth.
And net card fees, that's a big one for them, surged 20%, even after you adjust for, currency exchange rates.
20% is huge.
It is. Shows the power of their fee-based model. They also added 3.1 million new cards in the quarter.
Wow. Where's that growth coming from?
Especially strong in the U.S. consumer segment. And, the company's overall financial health score is rated good, about 2.84. Plus, 7 different analysts actually bumped up their earnings estimates recently.
Interesting. So analysts are getting more positive even as the market reacted nervously.
It seems that way. And management, they definitely sound confident. They actually reaffirmed their guidance for the whole year.
Oh, they did. What are they projecting?
They're sticking to 8-10% revenue growth for the full year and EPS between $15 and $15.50. So no backing down despite the market wobble.
That is a confident stance. And we know their strategy really hinges on those premium cards and partnerships, right? Like that Coinbase deal for crypto rewards.
Exactly. That's the core. And their credit performance, it's really remarkable. Stands out.
How so?
Well, for the quarter, they kept their return on equity at a very strong 36%. But maybe more telling is the Fed's stress test results, the CCR.
Right, the big bank health check. How did it do?
Best in class, basically. They had the lowest projected credit card losses under the stress scenario and the highest profitability rates.
Lowest losses and highest profits under stress. That's impressive.
It really is. And get this, their delinquency rates, people paying late. For U.S. millennials and Gen Z customers.
Always a focus area.
Not only are their rates better than the industry average for those younger groups, they're almost 40% better than the industry average for older age groups.
Wait, better than older groups on average?
Nearly 40% better. It just speaks volumes about the quality of the customer base they're attracting and retaining, even among younger demographics.
That is genuinely fascinating. And they've kept paying dividends, too.
Oh, yeah, for 55 straight years. And they just grew the dividend by over 17%.
Okay, this leads to a really key question for me. How does Amex do that? How do they keep this top-tier credit performance and loyalty, especially focusing so much on premium when everyone else is chasing those same customers?
It really comes down to the philosophy driven by the CEO, Steve Squeri. He often says two things. Consumers will pay for value, and we treat every customer as if it's the only customer we have.
So value and service focus.
Right. He argues the whole competitive game has shifted. It's less about just the APR or the fee itself, and more about the total package, the partner-rated value, the service, the experience. It's an ecosystem.
An ecosystem, right. And speaking of value, they've got that refresh coming up for the Platinum Cards Consumer and Business this fall. That sounds like a big move to bolster that value proposition.
It is a big move, but it's also part of their regular rhythm. Amex has basically owned the premium space for, what, 40-plus years?
Dude, they pioneered it.
So these refreshes are proactive. It's not just a knee-jerk reaction to Chase or Citi or Capital One entering the premium space more aggressively.
So they see it as staying ahead, not just catching up.
Exactly. And interestingly, Square thinks the increased competition has actually helped them by expanding the whole market for premium cards globally. More people are now thinking premium.
That's a counterintuitive take.
It is. He also ties pricing power directly to delivering that value.
Right.
When they hike a fee, the internal mandate is to add, quote, incrementally a lot more value.
More value than the fee increase.
That's the goal. And the value needs to be easy to grasp and use, even if people don't literally max out every single benefit. It's the perceived value that matters.
Makes sense. Okay, let's talk about a very tangible premium benefit. Airport lounges. Love them or hate them, they're key, but they get crowded. How's Amex handling that, especially with more competition?
Yeah, lounge access is definitely a flashpoint. Overcrowding can really dilute that premium feel.
For sure.
So their strategy is multi-layered. One, expand existing Centurion lounges where they physically can. Two, innovate with new concepts. Like they have this sidecar lounge in Vegas. It's like a speakeasy style, quicker visit, more exclusive maybe.
Interesting concept.
Three, work closely with partners like Delta Sky Club to manage access and flow. And four, develop smaller satellite locations to just handle overflow and offer basic amenities.
So spreading the load and trying different formats, it sounds like a constant balancing act.
It absolutely is. Grow capacity without wrecking the experience.
Okay, so the strategy seems robust, they're executing,
Yeah.
but no company operates in a vacuum. What are the big clouds on the horizon, the headwinds they acknowledge?
Yeah, they're definitely watching things. Economic uncertainty is always number one. You know, if there's a big downturn, consumer spending, especially premium spending, could take a hit.
Naturally. What else?
Market saturation, as we said, everyone's piling into premium. That could lead to a benefits war where costs just spiral.
An arms race, yeah.
Regulatory changes are always a potential threat. New rules could impact fees, interchange, lending practices, and technological disruption. Think beyond just crypto, like faster payments, embedded finance, neobanks chipping away.
Right, the whole fintech landscape is moving fast.
And finally, just basic currency fluctuations, FX volatility. A big chunk of their business is international, so a strong dollar can hurt reported revenue.
Okay, lots to watch. You mentioned tech disruptions, and that brings us neatly to digital currencies. They did the Coinbase partnership. What's the bigger Amex view on things like stablecoins or blockchain?
It's quite specific, actually. They draw a clear line. Things like Bitcoin, Ethereum, they see those mainly as investments like digital gold, assets, not really as payment tools to replace dollars or euros day to day.
So not for buying coffee.
Not really, in their view. Their focus is much more on stable coins, the ones pegged to traditional currencies, and potentially central bank digital currencies down the line.
Okay, and what's the use case they see for stablecoins?
Primarily in streamlining payments, especially cross-border transactions for small businesses. Imagine paying a supplier overseas without dealing with multiple currency conversions and delays. Stablecoins could potentially simplify that.
So efficiency gains.
Yeah. They see Amex, Visa, MasterCard as becoming the key off-ramps, the way people and businesses move between these new digital currencies and the traditional banking system.
Interesting. But are they worried digital currencies will just bypass them entirely, replace the card networks?
They're pretty explicit about that. No. Square basically said the current payment system, quote, is not broken. He argues the existing rails provide huge benefits that crypto, in its current form, doesn't match things like rewards points, the ability to lend, that's the credit and credit card, dispute resolution, fraud protection, near universal acceptance, and just sheer ease of use.
Right, all the stuff we take for granted when tapping a card.
Exactly. So they see digital currencies as something to integrate where it adds value, not as an existential threat that replaces their core business.
Okay, that clarifies their position.
Yeah.
So wrapping this all up, what does this mean for, the listener? Maybe they have an Amex card, maybe they're just watching the financial space. What's the takeaway?
Well, I think the takeaway is you have a company here, American Express, that is performing very strongly right now. Their core business model focused on premium spending and fees is proving resilient.
Despite the market's jitters.
Despite the jitters, they have clear strategy, they're executing on it, especially that premium playbook, and they're thinking quite deliberately about new tech like digital currencies integrating, not just reacting. But all this is happening against a backdrop of a market that's clearly cautious and asking tough questions about sustained future growth in a tougher environment.
So strong present, but questions about the long-term trajectory remain.
That seems to be the tension.
Okay, so here's a final thought for you to ponder. As American Express keeps pushing this value over volume strategy, refreshing cards, exploring digital tools, consider this. In a world just drowning in information and choices, is that core belief that consumers will pay for value their ultimate long-term advantage, the thing that lets them beat market doubt, or does it have built-in risks? Especially as everyone else tries to copy their premium playbook. Could that value proposition get diluted or become too expensive to maintain? Something to think about.